and it's a focus session, and we're trying to focus on early stage shared ownership offerings from developers to communities. And the running order is really myself first to run through shared ownership and the care support and set the scene for what we're talking about here and some of the early learning that we'd like to share. I'm delighted that Kirsty OBrien from Invicta Public Affairs will be able to tell us about their experience with the Salaki wind farm in Sutherland, which is a pre-planning consent project, but has recently completed a memorandum of understanding with the community there for shared ownership, and some interesting outcomes and learning from that we'd like to share. And also Andrew Wilkinson of Financial Advisors QMPF, who work with us on a number of community projects, including shared ownership. And we've asked Andrew to talk to us and to go through a few slides on what financial information you would expect in an early stage project and what could be included in an MOU. And as I say, we'll do the Q&A at the end, and hopefully if we'll start recording in a second here. If Gemma, would you be able to record?
Yeah, of course, Mark, that's started now.
That's grand, thanks very much.
We'll continue to admit people if they do come in as well.
Thank you. Right then, guys, we'll start off with the shared ownership journey. And just to set the scene, really, for anyone who's, just to be clear about what we're talking about here. And really from the top, and apologies to many of you who have seen this before in presentations, but really the main driver behind shared ownership is the Scottish Government and the Scottish Government's good practice principles for shared ownership of onshore renewable energy developments, which is a booklet that you'll find. I mean, you'll get access to that through our own Local Energy Scotland website and the shared ownership page there. It's also available on Scottish Gov website as well. But just to put it all in a nutshell, shared ownership will form a key part in helping to meet our targets of 1 gigawatt of community and locally owned energy by 2020 and 2 gigawatts by 2030. We expect community involvement in onshore wind development to continue to play a vital role in reaching these targets. So shared ownership and onshore wind in particular are priorities for Scottish Government to achieve the 2030 target. 2020 target, 1 gigawatt, was largely achieved, and the next gigawatt will be a little bit tougher, but shared ownership will be at the centre of that. So just to be clear, just to get out of the way, in case there's any confusion here, what is shared ownership? And again, from the good practice principles, and it's quite key, any structure which involves a community group as a financial partner over the lifetime of a renewable energy project. So again, to be clear, this is not the £5,000. A lot of you will be familiar with £5,000 per megawatt per annum of community benefit, and shared ownership it's a separate arrangement and it's additional to this community benefit fund as well. So Scottish Government are keen to encourage that both community benefit and shared ownership is offered on up-and-coming projects. So I'll just a little bit more on what shared ownership looks like, and again set out in the good practice principles. Common shared ownership models that we see in a lot of our projects, split ownership, where you purchase, say, 1 out of 10 turbines. I mean, that's not so common. We certainly have one project that we're working through, hopefully with a bit of luck, to completion early next year. But it's not a common model, it's a difficult model. It's basically owning a discrete project for the community itself. It can be an option. It was popular a few years ago when grid connections could first be shared between 2 projects, including a community. Joint ventures, we see a lot of those, of course. That's something that I think is better understood, and it involves communities purchasing shares in wind farms. And shared revenue, which is quite an interesting one. It's often mentioned, it's often offered to communities. We haven't really worked one through yet, still early days, not so quite well known, and but often preferred by developers and offered to communities, as I say. So the shared ownership opportunity is primarily for local communities in and around wind farms, perhaps hydro schemes as well. So it's typically the community council areas around a wind farm, perhaps, typically again, maybe half a dozen or so, but anything between 1 and 20 or more community council areas can be involved in these opportunities. So it's very wide and varied. Have to mention investment risks, and the value of any investment can go down as well as up, unfortunately. It won't be news to anyone, I'm sure, but it is an investment opportunity for the community, and we have to be aware of that, and we have to treat it accordingly. And in particular, we're aware of Financial Conduct Authority requirements for financial advice for communities as non-professional retail investors, and advisors need to have the proper authorities and permissions to do that, and the necessary experience, such as our own QMPF here have. Suffice to say that Local Energy Scotland is not authorised to provide investment advice. We provide impartial support via the Community and Renewable Energy Scheme, CARES, which you've heard about if you were involved this morning in the earlier sessions, but I'll just go through CARES a little, just at a high level, just to let you know what CARES is about as well. So, Community and Renewable Energy Scheme. The goal of CARES is that communities across Scotland are engaging, participating and benefiting in the energy transition to net zero. And this can involve shared ownership projects, local energy system projects, community benefit projects, and all towards supporting community involvement in the 2 gigawatts by 2030 target. So Local Energy Scotland, which is a partnership of local energy agencies, if you like, including EST, Energy Saving Trust, who I work for, and regional energy agencies, the length and breadth of the country, deliver CARES for the Scottish Government. Essentially, you'll be glad to hear, if you don't already know, that CARES provides grant and loan funding, as well as advice and resources to all manner of community and locally owned renewable projects. So it's a team of development officers, regionally based specialist support, like for shared ownership, countrywide, as well as fund administration for the CARES grant and loan schemes. Over and above grants and loans and funding through CARES, there is quite a plethora of other information resources available online, including toolkits for doing various things and tasks in the renewable energy business sort of sector, framework of suppliers, case studies, the good practice principles that I've referred to earlier, and much more besides, I suspect. And again, yeah, primarily grants and loans and access to technical advice for communities. The overall aim of CARES, I would like to say, is really to make the journey and to make community renewables as easy as possible for communities. So, we're not averse to rolling up our sleeves and getting involved in projects and supporting them as much as they need and as much as we can manage. And that's really what we're trying to offer here. So, just to set a bit more closer context of what we're going to do today, I think it's useful to split the sort of shared ownership journey into two sort of different phases or stages. Pre-planning consent and post-planning consent. So the early stage, pre-planning application to the planning authority, is what we're going to focus on today. We're working our way through the first few projects, in both phases, if you like, but it's still a fairly early days in this sector, in rolling out unsubsidized wind farm shared ownership projects. So we're learning and trying to share as we go along. So really, we have a process, and this is based on experience over the last 2 or 3 years and going through some of these projects, where Local Energy Scotland, as an impartial advisor, if you like, to communities and project owners, We will present shared ownership information and cares information to the local community. Now, often that's as part of the pre-application consultation process. And a community liaison group sort of forum. So we'll tag along to that and tell people about shared ownership. And if they're interested in taking a shared ownership opportunity forward, then we would like to seek agreement with the community council representatives and any other development group representatives who are interested in the community, like an agreement who would take it forward. We need one applicant to apply to CARES for funding and for support, and we'd seek a group to act as lead on that process. And once that's been assessed, that early assessment's been made, we often see, and it seems reasonable to complete a memorandum of understanding to capture that agreement. And we have Kirsty here today from Invicta to tell us about her experience with that next. I'll just say a little bit about the post-planning consent. We have a project or two now who are going through that process to try and establish an unsubsidised shared ownership agreement. And when that information and learning becomes available, we'll go through that as well. And maybe in a similar session to this, at a later date, sometime next year, but as soon as possible. But we really see that process as being, in terms of documentation and milestones and stuff, that the developers would produce a heads of terms document to narrow down the opportunity and what's on offer and put more detail on that. And we would support the community to take professional, financial and legal advice typically to agree a heads of terms. And then the developer would eventually, all being well, produce an offer document on which again, we would support the community to take advice, appropriate advice, make a decision, an informed decision, and all being well, take that opportunity forward. So I think we'll just move on quickly now. We're going to have a couple of presentations for about 10 minutes or so, and hopefully 20 minutes or so at the end for some Q&A there. And I'd like to welcome Kirsty OBrien from Invicta Public Affairs, who's been closely involved, as I mentioned before, with Salachy Wind Farm in Sutherland and the recently completed Memorandum of Understanding process. So over to you, Kirsty.
Thank you. I will just share my screen. If you can see that okay now. Yep, all good. I'll just want to present. Well, good afternoon. Thanks for having me along. As Mark said, my name's Kirsty OBrien. I work for a company called Invicta Public Affairs, and I'm here primarily to talk about our experience with the Salachy Wind Farm project. For a bit of context, Salachy Wind Farm has been brought forward by a German developer called WKN, which is a subsidiary of the larger P&E group. WKN have been operating for around 30 years and have been active in the Lerg region where Salachy is proposed to be based for around 10 years. The company I work for, Invicta, we lead primarily on stakeholder and community relations for numerous projects across Scotland, but we take a more active role in the Salachy project. Given that Salachy has been brought forward by a German company, we are their engagement partner and their eyes and ears on the ground, which has been actually very beneficial given the last year and a half we've all just had. It's allowed us to push forward with the application, stick to the timeline of getting it submitted, all the while I'm still here and able to go and meet and engage all of our community partners based in Scotland, with restrictions on the wider team being able to actually come over. The project itself, for a bit of background, is on the A38 outside of Lerg. It is a revised proposal from 22 initial turbines in 2015, which was a Section 36 and refused by Scottish ministers, to a revised single row of 9 turbines, which was submitted in April to the Highland Council. They have a tip height of 149.9, a maximum output of 50 megawatts and a 30-year lifespan with a grid connection date of 2023. Ideally, we will have planning determination for the project by the end of this year, but with issues in COVID, etc., we may see that slip into early next year, but we are still pushing forward, hopefully with a consent for a grid connection of 2023. I will touch on community benefits slightly, just as this is a catalyst, was the main catalyst for us to bring forward shared ownership. There's a community benefit offer of £5,000 per megawatt for the project, which first established our community liaison forum. Now, our initial community liaison forum in 2015 involved the three main communities of Lairg, Creek and Ardguyn district, which make up central Sutherland. When we came back in 2018 to bring forward a smaller revised scheme, it was brought to everyone's attention and discussed that the three northwest communities of Scowrie, Durness and Kinlochbervie should be involved in the project. This was all suggested because they are on the main trunk road out of down to Lairg and into Inverness, which would mean that they would actually, more than perhaps the residents in Lairg, Creek and Ardguyn, see the wind farm. And given that they're in the very, very northwest, which is hindered by wildland and national scenic areas, where we've seen across Scotland numerous communities thriving and developing with, whether it be ownership money or community benefit money, the northwest really hasn't had that opportunity yet, so Salake will be a first for them. These 6 communities then made up our community liaison forum, which when we were sat, we meet 2 to 3 times every year, right up until 2020. That was all in person at community centres, big roundtable events, and at one point we were sat there with 20, 25 people round a table, all invested in seeing a project come forward, where they eventually brought their development trusts, and the discussion moved positively towards actually investing in the ownership. Now, for the first application in 2015, we had MOUs for community ownership and community benefit, but these were very simple and really just committed to exploring it further. What we done in 2018 is we sat round the table with the 6 community councils and restated our offer to offer a 10% ownership stake in the Salake wind farm. The development trusts of Lairg district, which covers the Lairg area, the Kyle of Sutherland, which covers Creek and Ardguyn district, and the northwest communities, which would cover Kinlochbervie, Scowrie and Durness, all took a more central role. Lairg district community initiatives and Kyle of Sutherland are both established development trusts. The Kyle of Sutherland has taken a very active lead role in these discussions and have done some wonderful work in the wider area and have really pushed forward in recent years as a real hub for the central community. The northwest communities is in the process of setting up their development trust, and having been sat around the table with the Salake project and seen what other communities are doing with their money has really pushed them on to do this. The benefit and the reason I'm touching on this of having development trusts is that was where we saw the real opportunity to really fully explore community ownership with a community trust which has a more business-like model as opposed to a community council, but represents the community council. We saw people within that group who were prepared to put the time and effort into really exploring creating a sort of legacy project for the area. It was initially touched on in 2018, where we sent the communities away with the good practice principles you heard Mark talk about and our offer, and invited them to come back at our next community liaison forum and give us their feedback. At those meetings, as I said, we had about 20, 25 people around the table. It was agreed that if we were really going to explore and get into the nitty-gritty of what community ownership could do, we would nominate, each development trust would nominate 2 people within the CLF who met a further 6 times across 2019, 2020 to really explore if this was something that they were interested in and formulate a draft MOU. This was where Local Energy Scotland and also Foundation Scotland were in attendance, and they really acted as a community partner and helped them all the way through these 6 or so meetings to really formulate if this was something they were interested in. The communities came back, agreed it was something that they wanted to explore, and they took out their CARES grant. The CARES grant allowed them to get the correct legal and financial advice, which involved the developer answering a lot of questions, the developer's legal team answering a lot of questions, myself and the development team heading up to Inverness to meet with the community's financial advisors and really get into the detail of what would happen if the communities did own a 10% stake in the wind farm. This eventually, towards the middle of 2020, we formulated a draft MOU, which I do have to say was about triple the size of the initial one we'd signed in 2015, which had a lot more expertise and detail into it and really secured the community's interest and weighted a lot of the commitment in favour of the developer. I believe, I wouldn't show you our MOU today, but it is available just because it's so long and detailed, but we submitted it as part of our application, so Mark or I can direct anyone who's interested in it to the correct link to go and view it. A lot of the feedback we had with the community and through their legal and financial partners was the financial aspect, which was a bit of a stumbling block through the process, because until we have an established planning consent and we have a candidate turbine and we have a real construction plan and timeline, we can't really commit to the financials of the project, which was a little bit of hesitant on the community's part, but eventually what we established was that maybe changing some of the wording in the MOU to change it to the community would not need to take up their investment until the point of operation, so that the construction timeline, everything that goes on between consent and the actual first day of operation, all those risks and financial elements are weighted solely with the developer, so that when we get to a point of operation, the community would see exactly what the investment figure would be and exactly what their potential returns would be. That's one of the main changes we made, and it was one of the main changes that everyone was happy with. And then we took it back, the MOU, to our legal team, the community's legal team, and eventually at the start of 2021, we had this agreed and signed off, at which point we took it back to our big 25-person community liaison forum and had the signatures of all 6 community councils on the document, and then it was submitted as part of the planning application. The planning application was submitted, and the MOU for both community benefit and shared ownership alongside it. And in our engagement with the Highland Council, they've acknowledged that these are one of the first MOUs they've had submitted, the first real commitment from projects to develop it. So we have had meetings with the local authority explaining to them the work we have done and what this means and what we, as the developer, are committed to offering the community to do. In my experience, the real catalyst for bringing forward something like shared ownership is the community, the people involved in it. It does take a lot of time and effort, and folk with real vision to create a legacy project. Community benefit can be spent on projects here now in the next few years, but community ownership is something that people can see as bringing forward something for 10, 15 years in another generation. There is an appetite for this, especially in somewhere like the Highlands. There is an appetite for communities to bring this forward. They want to develop it, and we, the developer, want to leave the area in which we're investing in a better place than we entered, and leave a real legacy project. Things can be done, and things have been discussed that the developer could put forward the financials to help with the community investment, but these are all things that would be discussed post consent. As we touched on at the start, this project is still in planning, and with Hopefully we leave the end of this year with a planning consent and can bring this forward, at which point we have committed to having a more detailed roundtable with everyone's advisors present. It was all kind of virtual the past year, as you can imagine. Everyone's advisors present, where we would formulate an offer, present heads of terms, and as we go down our construction route, come to the community with a final offer, and it's up to them at that point, should they wish to invest. But with the A38 project, there's been a lot, as I say, of time and effort put into this that I personally am really, really confident and hopeful that this is something we will be back here in a few years' time, telling you about the success that we've had with actually finalising a shared ownership offer. But on the screen there's just a few testimonials from the community. But yeah, I really do hope this presentation can grow and we can be back with some real examples of how we've really finalised our offer, and we are pushing forward with a pioneer project. So thank you very much for listening.
That's great. Thanks very much, Kirsty. Definitely one of our first full sort of MOU processes there, where we've been closely involved with the developer. I'm going to just round up just a couple of learning points from here. So I'm just going to share my screen again for Andrew there. Let's have might be a wee bit of delay here. Just bear with me a sec. Yeah, just to sort of highlight some of the outcomes of that process and some of the learning, and lead into what Andrew's going to talk about. And say it's a focus session. We're trying to focus on what we're often asked about in terms of financial information at an early stage. And I think it's fair to say that with our Saliki experience, the financial advisors found it very difficult to actually get sufficient information pre-planning consent to determine what return there might be for the community. So that's kind of the focus going forward. But I'll just run through some of the outcomes, and we have this. There's a CARES case study available as well on our website for the first of this kind of up-to-date unsubsidized project. So it's the most up-to-date one that we have. But you know, just fairly simple things that might seem on the face of it, but it's very good to have these things nailed down and for the work to have gone into this in the early stages of a project. So I'll just run through these. So the MOU, with Saliki now provides a clear statement of intent, of course, and it clearly defines the parties involved, community councils, their development groups, as Kirsty's mentioned there as well. It clearly defines the company structure required or the preferred model going forward. In this case, perhaps a shared revenue, but absolutely not cast in concrete, as they say, because things might change and still needs to be tested. Yeah, one group, quite typically one organization, the community coming together under one umbrella organization to invest in the project to make things efficient, you know. Now, quite uniquely, I think, and interestingly, for Saliki, we mentioned Kyle of Sutherland Development Trust being the lead group here, and at, I believe, their behest and the behest of the community, it's been written into the MOU that if shared ownership doesn't work for the community eventually, for one reason or another, they could take the option of an alternative investment over and above community benefit in terms of an enhanced community benefit payment, but where the performance of the wind farm is taken into account. So it's a step, and a very low risk step, on the way to shared ownership. So that if all else fails, there will be that opportunity. That's fantastic. As I say, it's a unique opportunity. It's over and above the requirements and the good practice principles arrangements, and that's what came of a negotiation with between the right parties, a willing seller and a willing buyer, if you like. So yeah, also in the MOU, importantly, a timeline to finalise the model and the term sheet, a timeline to produce the investment offer documents, so you know when you're going to need things. They're way down the line, I think we discovered through this process, and a timeline for community to make its final investment decision. Typically, we see that as being 6 months or so post-commissioning. So it's the low-risk end of things, gives plenty of time. And for communities who are dipping their toes in the water here for the first time, that's definitely needed, that sort of length of time and that sort of risk profile for many communities as well. Not for all, but certainly for many that we've been working with. So the timeline to complete the investment. So I hope it's come out just through what we've been saying here on Saliki, that the MOU process aids a better understanding of the opportunity and the project, as well as encourages engagement between the parties. So that relationship has certainly grown in my experience, and from what I see through bringing in advisors and looking at an early agreement, and understanding of the project. So look, from this, Local Energy Scotland can now provide a template MOU and guidance notes, and will soon to be made available online. Our website has been refreshed at the moment, and there'll be a new shared ownership page there, and we'll make that key documents. We don't want to flood it with all kinds of resources, but these key documents like this template MOU guidance will be made available there, as well as good practice principles and other documents as required. But I think one of the things that really stuck out, and Kirsty did mention there, that the financial advisors looked at that, and the understanding was there was insufficient financial information available pre-consent to estimate the likely returns. And we're often asked, and if I was there with my community hat on, I'd be wanting to know, what's this going to be worth to us? We're going to be putting in a few years of our voluntary time and effort, and we don't know if it's ever going to happen. I mean, will it be worth it in the end? It's very difficult to say, but I suppose there has to be some belief that the developer wouldn't pursue it to the bitter end unless it was going to be something in it for them. And we believe, and the good practice principle suggests, that if it works for a developer, then it should potentially work for a community as well, if it's open, transparent, and equal. So these financial questions are quite key. What should be expected in this early process, and what can be asked for in an MOU in terms of the timeline and the financial advice that's required. So I'm pleased to say that Andrew from QMPF has agreed to try and address this and give us some insight into the financial requirements and what to expect at an early stage process. So over to you, Andrew.
Yeah, thanks, Mark. Just see if I can share my screen. Right, is that, hopefully people can see that?
That's grand.
Yep.
Great. So, no, thank you very much, Mark, for the introduction there. And just to introduce myself, so I'm Andrew Wilkinson, and I'm a director in QMPF's Energy and Renewables team. And for those who don't know us, we're an Edinburgh-based corporate finance business, and we specialise in energy and infrastructure. We're also FCA authorised and regulated to provide financial advice to both professional and retail clients. And that includes organisations like community trusts and community councils as well. And some of the work that we've been doing recently has been along that basis as well. So I've noted here some of the main sectors that we're involved in just on the bottom left of the page. But I think the key one here for the discussion is around energy and renewables. And some of the recent examples of work that we've done include things like, as Mark mentioned before, so advising Local Energy Scotland directly in support of the team there on delivering the CARES programme. So in doing that, we've worked on quite a range of different projects, including onshore wind and hydro as well. And separately, and I suppose on the other side of it as well, we've acted directly or advised directly some community trusts and some community organisations around potential investments in both operational and projects that are in development as well. We have wider experience in wind and solar generally on onshore projects, which I'm not necessarily going to go into in a lot of depth now, but also just to mention as well in low carbon heat, which is a big push at the moment, and especially working with councils across the UK, but predominantly in Scotland as well. So what I was, as Mark had mentioned earlier, what I'm looking to go through at the moment, just very high level, is some of the information requirements and some of the financial considerations at the early stage in looking at a project. And I think it's probably worth picking up again on some of the comments that Mark made already in terms of yeah, sorry, got a bit of a sticky mouse here. Instead of in terms of when the MOU process happens, and that's, as we mentioned, it's quite early on in the process, so it's predominantly before the planning consent has happened. But really, it's quite important because it sets the direction of travel for the process as it develops. So key that is right and set off on the right foot right from the start. And also, at an early stage, it provides an opportunity for both parties to shape the discussion. So again, that process probably wants to be started, that dialogue starting before the MOU is actually drafted. And from the community side, I think it's worth considering a few things that should be thought through to consider what should be in that MOU and therefore what information should be available. And I've noted a few just on this page here, just in terms of sort of broad questions. And I think here, really just starting at the top, there's a couple of really important ones, and that's the community's capacity to invest. So does it have its own sources of finance, or does it need to raise them from external sources? And that could be from a commercial bank or potentially from some sort of Scottish government support as well. But it could be sort of directly from within the community as well, sort of from members of the community. And that financing source and where that comes from could impact on the scale of investment, which the community could take into the project. So, for example, if it's getting its capital internally or it's using its own funds, that might limit the size of investment. It might put a cap on it. But conversely, if the capital is being raised externally, so if the community are borrowing money for it, it might actually put a minimum size on it. So you might have a minimum size that's actually going to get a bank or another funder interested to make it worth their while going through the diligence process and the structuring, because they probably want some minimum investment ticket size there as well. Another sort of key consideration and one that we often come across as well is the capacity for loss and downside. And what I'm thinking about here really is the implication for the community in the event that, for whatever reason, that the project doesn't perform. So does the community have the ability to put its hands in its pockets, for instance, if it needs to, and if it's got an equity stake in a project, or can it live with, for instance, something like reduced income in that period if the project isn't performing? So all those things really will go into sort of defining what the community's return requirements are, and really what makes participation in the scheme worthwhile. Again, like has been mentioned before on both presentations, really, is to at this stage of the process, it probably is quite early stages to assess actually what's going to come out of the project, but at least having some bounds on what is acceptable to different parties and predominantly the community as well, and what they're looking for can really help that. I've put on a couple of other boxes in here, which probably to some extent are a little bit of a catch-all, but and they will be project specific. But a couple of those considerations as well might be around whether the community has the ability to actively manage its investment, or whether it wants to be a little bit more hands-off. And therefore that might influence things like the information requirements that are coming through, what participation sort of the community and representatives of the community might want to have in terms of managing that investment going forward, and the strategy as well. And it might drive you down one or another of the different routes that could be available for shared ownership. There's as with all projects, there's bound to be community specific or project specific considerations as well. And an example that I was thinking of here are things like if there are different community groups in here who are in receipt of community benefit, are all of those communities looking to invest, or are some of them not looking to invest? Because that might influence how community benefit is treated, and does some of it have to be ring fenced from others if some of it can be used for investment but some of it can't. So getting around the table, understanding all that from the community's perspective before going into actually getting information out of the project and the developer, I think it is quite important and time well spent up front. Because really what that's going to be able to do is allow the community to think about the type of shared ownership model. So putting all that together, it might lead you down one route. It might be sort of JV or shared revenue, or potentially even something else. It'll also, as mentioned before, sort of give an indication of the scale of investment. So is that limited, or is it, or do we need a specific minimum amount to invest in, and how might that be funded? Because thinking about the funding route early on is I think quite important as well, especially if funding is coming in from external sources where they might require particular security or particular structure. So putting a marker down in the sand early doors, I think is very helpful. And also the ability of the community to access the community benefit up front, which it might be able to use to fund some of the investment, which I know we've seen on various projects or put forward on various projects in the past as well, and is part of the sort of the good practice principles as a potential option for funding. So that's thinking about sort of the early stage, sort of engaging in the project and thinking about how it might be structured for a community. If we then move on to actually what does that mean for the information requirements. So what I've tried to do is sort of split this into a couple of different areas, and recognizing at this stage that it's not an exhaustive list, but it sort of should give a flavor of from what we, as looking at it from a financial perspective, would be looking at early stages of the project. And again, with the caveat that some of the project information might not quite be available, sort of pre-planning. But really, yeah, the three categories that I've split this down into. The first one is really around financial. So ideally here, to assess a project, what we'll be looking for is a financial model. It's likely that the developer probably does have a financial model, as they'll be developing their project anyway and looking to see what the returns in it for them. But worth saying, and I think dwelling on the fact as well, that at this point in time, it's likely that that's probably subject to quite a bit of movement as time goes on. And that could be something as fundamental as not even knowing how many turbines would be in the final scheme once it goes through the planning. So it's not going to be the final model. It's not going to be, there's still going to be a lot of movement to get to a final model and to look at the sort of the actual finances that come out of it. But at least it should give an indication of what's on the table and what the project might look like. But in thinking about that, the real things that we'll be looking to get a handle on are around sort of the costs of the project. So how much is it likely to cost to build and sort of operate as time goes on? What might the energy yields look like? So how much energy might this project produce? But importantly as well, around the contracting strategy. And here I'm thinking about how the energy that it generates will be sold. So would it be merchant and just sold at market prices? Would it be sold through a corporate PPA and potentially at a fixed price, or perhaps even with a contract for difference? And that all impacts really on the risk profile that the community might be getting themselves, might be taking when they're investing in the project or taking a shared ownership stake in it. So it impacts on required returns, but it also potentially impacts on whether and how they can fund the project themselves. So what does that revenue stream look like that's going to be paying back the funds that they've borrowed or they've raised to fund the investment in the project? So that's all quite important at an early stage. And then on the structuring side, we talked about before about some of the different considerations that go into that. But really what we'd be looking to understand at this stage is really how and when that investment will be made. So is it pre-construction, is it post-construction, and what risks are still on the table for the community at that stage, and what model that is. So is it revenue share, is it a joint venture, or again something different, and how will the community receive its income? So examples there could be things like, if it's a revenue share, is it a gross revenue share, so before costs are paid by the project, or is it a net revenue share, so after costs are paid? And again, that impacts on the required returns that you as an investor may have. Included in that as well would probably have the use of community benefits. So what is is it available, and what are the mechanisms around using those for investment in the project? And sort of leading on from that, I think one of the key points as well, and we've seen this on a couple of projects recently, is understanding the price that's being proposed. So at what price is the developer offering the community to buy into this project? And probably worth saying that even though the price, the actual pound note amount might not be known, the mechanism or the intended or the expected returns or broad return envelope might be sort of on the table at that point. And I think at that point, it's probably worthwhile the community really looking at that and potentially benchmarking if necessary, and potentially even negotiating that with the developer to get the sort of the best possible deal from their perspective. And I suppose linked to all that and the structure and the funding source, what a key point as well is around the security and what potential security might be on offer for the community and its funders. And I think, again, it's really worth putting a marker down in the sand at this stage as to how this project or how this investment might be funded, because different funders, whether it's a bank or whether it's Scottish Government funding or some other type of funding, may have different requirements on structure and security, and that may or may not be available from the developer. So a discussion around that, just to make sure both parties are aligned at this stage, I think is quite important. So I think really the financial and the structuring element should give the community sort of the ability to assess whether it really does it broadly make sense, subject to a lot of the numbers being finalised and the scheme being finalised, and whether it's likely to be possible to fund it, depending on what the anticipated funding source is. And again, understanding the potential revenues and the potential returns, if they're available at this point in time, will help assess whether it's something that you want to pursue or not. But really, that's around sort of probably a go or no go sort of decision for the community at that stage, on whether there's more negotiation to be done. I've also noted a couple of other points here, and it's some things that we've seen come up as well that are probably worth understanding and information requirements at sort of at this stage as well, and that could be things around sort of restrictions on the community. So things like, can they sell or transfer the investment later on if their circumstances change? Sometimes that's not possible, sometimes it is, but again, it might impact on the community's view of the project or the investment. The other is use of proceeds, so there might be restrictions as well on how proceeds from the investment can be used by the community. Again, probably nothing untoward here, but useful to understand. And again, as well, one thing we have seen is potential restrictions on the ability to invest in other projects being developed by other developers in the local area, if the developer could see it as impacting on their project as well. So probably project specific, but useful to understand. And a final point that I mentioned as well is around understanding the developer's long-term strategy, and that could be from anything from sort of a buy and hold, so they intend to build this and hold it for the long term, or they may want to refinance their own funding of the project or sell it in the future. And it's really the latter that is probably of use to or worth dwelling on for the community, and that's if they are a majority shareholder. One thing that can happen there is majority shareholders on a sale process can be dragged along with the majority shareholder, and really, and it might be too early at the MOU stage, that might be something more for the heads of term stage, but again, putting a marker down in the sand to understand that mechanism and how the community can protect its investment, that it potentially is not dragged out at a lower value than it's invested in at the start, is a useful thing to understand as to the overall risk profile of the project and what will need attention later on. So conscious that's a very quick canter through what's probably quite a lot of information to get from a project to assess at this stage, but very happy to take questions through the Q&A process at the end, and at this point I'll hand back to Mark.
That's great. Thanks for that, Andrew. Yes, a lot of information there, of course, and that will be made available to everyone. And I'm conscious that, yes, we're running out of time. Much my fault as much as anyone else's for running through things and getting stuck in to try and get as much information across as possible. But perhaps it's best, rather than going back to a summary really of this. We have a couple of questions maybe that I think there's one for you here, Andrew, that we might just start. And if anyone else has any questions, if you look at the chat there, Andrew Smith from